My name's Adam. Welcome to the channel. Thank you for joining us today. Today we have a special guest, Chris Dyck. Chris is a CPA at Avisar CPA here in Langley, BC. They're an accounting firm. And we brought Chris in today to talk about emigrating from Canada, which is a big topic that you guys ask about. So we thought we'd bring in an expert to talk about the field and just what it's about and what you guys need to know. Like, this is a high-level view of what it takes or what it means to emigrate from Canada, the things you need to do, and really the kind of the tax side of things that we want to talk about today. The point we're trying to make today is there's more to it than you probably know, so make sure you reach out to your tax professional. And if you have any questions, comments, leave them below in the comment section, and Chris and I will do our best to answer those. So Chris, first question I have for you is, what is becoming a non-resident?
To become a non-resident, Tax Act basically says that you're severing your ties to Canada, and there are three major ones that generally apply there. One is you've sold your home. Two is your family, your spouse, and your kids have moved with you. And three is you've basically severed your social ties. You've made new friendships. You've really moved on with your life in that new country. And in certain cases where perhaps you might have a time where you have a house both in your new country and in Canada still, maybe you haven't sold the house in Canada, then it goes on to secondary ties such as where is your medical coverage, where is your driver's license, and other things like that.
Okay, that makes sense. Okay, Chris, this may be an obvious question, but should you notify anyone? If you're leaving Canada, is there anyone to notify that you're actually leaving?
Yeah, for sure. And the obvious one is obviously Canada Revenue Agency. You should let them know that you have become non-resident. Also Service Canada. So Service Canada is the organization in charge of OAS and CPP payments if you're a retiree. Canada Revenue Agency would control things like Canada Child Benefits or GST credits if you're receiving those. And then finally, any financial institutions where you might receive income from your investments, they have to know as well so that they can start to withhold tax, and we'll talk about that a little bit later.
Yeah, perfect. Yeah, you think all these organizations would talk to each other, but they don't. You think Canada...
Even Canada Revenue Agency and Service Canada, two different organizations.
Yeah,
entirely.
It's crazy. Like, you think it'd just be like one email or one phone call and it's all done, but again, there's more to it than most people realize. And you got to make sure you kind of check all those boxes, or you could run into a pretty nasty tax situation, which we'll talk about here. So the next question I have for you, Chris, does your tax return change, and is there anything you should do before you leave Canada?
Well, before leaving Canada, other than notifying the people we talked about, you probably want to sell your home if you can. When you are in Canada, if you're a resident of Canada and it has been your principal residence, we'll assume you just have the one home. When you sell that principal residence, it's tax-free. However, if you keep the home and sell it sometime when you're a non-resident, you may be taxable on that portion for a portion of time when you're not a resident of Canada.
Okay, so it's proportion of when you were gone.
Correct.
Now, there's a form or something that you can file?
Yeah, it's called a T2062. And basically, if you are a non-resident and you're selling property, whether it was your principal residence or not, you have to report that within 10 days of the sale.
So really soon.
Really
soon.
soon.
You got to be on top of it.
You really have to have that form kind of ready to go.
Yeah, okay.
So in the year that you leave Canada, you'll have a tax return that's from January 1st up until the date that you become a non-resident. And at that point, on that final return, it's actually similar to if you die while in Canada. You are deemed to have sold everything that you own for their fair value. So if you have investments that might have gone up in value, if you have a rental property, if you have shares of a company, all of those are deemed to be sold for whatever their fair value is at the time. And if you have a gain, that you need to report. And so it can be a very expensive proposition in leaving Canada. There are options if you have a significant amount of tax that you can basically post security. In other words, not pay the tax initially, but leave behind something of value that the government can take if you fail to pay that tax.
And even like if you have artwork or jewelry, that kind of stuff, like all these things, there could be a deemed disposition on. And people don't realize that. Like, we had someone a couple of years ago that left Canada realized all this afterwards. And, you know, it's a six-figure check they had to write. They had no idea. Well, they came back later. They said, well, it probably would have changed our mind. It was an expensive departure that we didn't realize. And again, this is why we're doing a video like this, to hopefully help people to avoid that situation.
Yeah. I mean, the more assets and the more complicated your tax situation is, the more you need advice and the more you need to just ask, even to know that you're okay.
Yeah, exactly. Yeah, no, good point. So the next question for Chris, and this I think is the most important question or the most popular question that you guys ask us is, how is income treated after you are a non-resident? So when you leave Canada and you have income both abroad and maybe in Canada here, CPP, OAS, and again, we've done a video, we'll link it above here, on what happens to your CPP and OAS when you leave Canada. We have a full video on that, so click on that if you don't know what that means for you. But yeah, what happens to income when you leave Canada?
So like we talked about before, so a big part of leaving Canada is notifying the various payors of your income so that they can withhold an appropriate rate of tax. So that withholding tax starts at 25%. And depending on if the country that you're moving to has a tax treaty with Canada, it could be reduced to as low as 5%, often 15% on a lot of the income. And then what happens is, because you're a non-resident, you don't have to file a tax return in Canada. That withholding tax is your Canadian tax.
Okay.
But then in the new country, if you file a tax return there, you would be able to claim a foreign tax credit that reduces the amount of tax that you have to pay in the new country. So it ultimately results in you having to pay the higher of the two tax rates on a combined basis.
Okay.
So if you have 15% withholding in Canada and your tax paid in the other country is 20%, you would get a full tax credit in that other country and end up paying the other 5% difference.
Okay. So then let's flip that example. Let's say a client or someone moves down to Mexico and the withholding tax here is, let's say, 25%.
Sure.
And the total dollar value of withholding tax is $15,000 on their RIF and CPP and OAS. Mm-hmm. They're down in Mexico, they're non-resident of Canada, and they file their Mexican tax return, and they add up all their income, and the taxes in Mexico work out to be $10,000. So they paid or withheld $15,000 in Canada, but their taxes due in Mexico are only $10,000.
Right.
So they're going to get the credit, so they're not going to owe any more tax, but they've actually had more tax withheld and paid than maybe they should have otherwise. And that's, I've said this before on the channel, sometimes leaving Canada for tax purposes works against you.
True.
And we've seen it quite often. We've done financial plans for clients in Mexico, and the end result has been you actually are paying more tax by living in Mexico than if you were here in Canada. Now, obviously, your house and everything else is much cheaper in Mexico than here in Canada.
True.
But leaving Canada doesn't mean you pay less tax.
Not necessarily.
No, not necessarily.
No. You end up paying, where there are two countries with the tax treaty, you end up on a combined basis paying the higher of the two taxes.
Yeah.
So in the case that you talked about, if the individual owed $10,000 of Mexican tax otherwise and had on the Canadian income, and it had 15% withheld, they'll not pay any tax in Mexico, but they don't get back the other $5,000 in Canadian tax.
Yeah, no, that's a good point. And that's a good point. So if you're looking to leave Canada, to emigrate from Canada, look at what the tax treaties are, look at what your income is, and work out, just grab a Excel spreadsheet and work out those tax numbers to see, will you be paying more by leaving Canada? And if you are, does the lower cost of living outweigh the added tax costs? Because it may not. Okay, so Chris, the next question, what about RRSPs and other tax-deferred investments? What do clients need to do with those?
Yeah, so I'll use the moving to the U.S. as an example. It's the one that's most common for the clients we deal with. And basically, the RRSPs can remain in Canada. They are continually tax deferred. Mm-hmm. So in Canada, you don't pay any tax on it. In the case of the United States, they also recognize it because they have a similar type of scheme. They also recognize it as tax deferred as well.
Okay.
So it's only when you draw the money out that you are taxed in Canada on a withholding basis and then have to report that same income in the United States. Other types of tax savings vehicles, such as a tax-free savings account, TFSA, or an RESP for your kids, those are not recognized in the same way in the United States and other countries. So although they may be tax deferred in Canada, you might have to report that income earned on those accounts in the United States or other country. So we generally advise people, because it is tax-free, to collapse a tax-free savings account, to do that before you leave.
Okay.
And the same with the RESP. It's very punitive in the United States, so it's best to just collapse those plans.
If you have an RESP and you think about, or you may come back to Canada at some point, and I say this because my brother did this, so he's down in the US right now. They may come back, probably not, but they may, and they had an RESP, so they changed the owner of the account to my mom.
Right.
So you can change it to a Canadian, someone that's resident in Canada. You can do that, but going back to the TFSA, it is very important to know that if you move to the States and you continue to hold your TFSA, it's tax-free in Canada, but the US does not realize it. Just like if you're a US or dual citizen in Canada, you can't have a TFSA account because yes, it's tax-free here, but the US taxes you on that income.
Right.
And I find it funny because the US has the Roth IRA, which works
a very similar system.
Very similar. Like it's different, but it's just a different shade of the same thing.
Yeah.
So hopefully one day they recognize the TFSA, but at this point, while we're recording this video in 2022, if you're leaving Canada, especially to the States, you're going to have to liquidate that TFSA. It makes the most sense from a tax perspective. So outside of your registered or investment accounts, is there anything else when you leave Canada that you would need to change? So credits, benefits, that kind of stuff.
Right. So two types of things that some people might receive are GST credits and Canada Child Benefit, depending on their family income. Once you become a non-resident, those stop. So that's part of contacting CRA when you leave Canada, as well as if you happen to have a home buyer's plan or a lifelong learning plan where you're withdrawn from your RSP for those items, those are repayable. And there's terms on how long you have to repay them.
Okay. So it works a little bit different. So be aware of that. We had a client the other day that applied for a home buyer plan and they still had a home buyer plan. So nothing to do with this video, but you need to know the outline and the rules around these accounts, and especially when you're leaving the country. So Chris, you touched on this briefly already, but if you leave Canada and become a non-resident, do you have to file Canadian tax returns anymore?
Most cases, no, but there are a few instances. For example, if you're a border resident and you still work in Canada, so you have employment income or maybe you have a business in Canada, basically Canadian sourced income, you still have to report on a Canadian tax return. As well, if you perhaps leave a rental property, your home becomes a rental property behind, you do have to report that rental income, and there are there's specific rules on how much you need to withhold and remit to the government on the rental income. A couple of options there.
Okay.
A little bit beyond the scope of our talk today.
Yeah. So make sure you have a good cross-border tax accountant if that's the situation that you fall into then.
Right.
Yeah. So Chris, thank you for joining us today. That's what we have for Emigrating from Canada. Again, if you're looking to emigrate from Canada, highly recommend reach out to your tax professional or find a tax professional in your area that understands leaving the country. Now, you might have a tough time if you're going to, let's say, Colombia, a Canadian-Colombian cross-border tax professional. But talk to a tax professional here in Canada, talk to one in Colombia, and start gathering information. Again, there's steps you have to take before you leave Canada, so make sure you know that. So Chris, thanks again for joining us today. Just a reminder to our viewers, we do still have the Black Friday sale on our masterclass, so you check that out. We'll put the link below. And the financial plan giveaway, we are giving away 2 financial plans. The draw will be in a few weeks here on December 16th. So make sure you enter for that. Again, you're not entering yourself, you're entering someone that you want to win the plan. So it could be a friend, coworker, family member, someone that needs help, needs a retirement plan, but maybe can't afford it. So thank you for joining us in this video. Thank you, Chris, for joining us.
Absolutely.
We'll see you in the next one.